Are you interested in cutting your healthcare costs by 30%? Healthcare costs are up, inflation is increasing, but most employees are leaving some money on the table with what's known as a healthcare flexible spending account. So today I'm going to show you what a flexible spending account is, how you use it, what the eligibility criteria is, and some gotchas that may end up costing you money rather than saving you money. And by the end of this video, you'll know exactly how to employ this strategy and how to save those 30% on your flexible savings account. All right. So what exactly is a FSA? It's called a flexible spending account, and there's a couple different types. So today I'm going to focus mostly on the healthcare flexible spending account, but there's also a dependent care flexible spending account that does almost the exact same thing. So if that's what you're interested in, please stay tuned because you'll also hear about that one as well. So how is it funded? It is funded through a payroll deduction that is elected in the open enrollment period, which is about this time. In the November timeframe, you're electing what you'll do for next year. So this is an employer-owned item. So as you contribute to this, it goes into an account that is controlled and owned by your employer. But you control how that money is spent with some restrictions that I'll get to later on. One negative side is it is not portable when you leave your job. So if you leave your job, any remaining balance in there goes back to the employer. So that's something to watch for. But on the opposite side of the coin, it can't be recouped either. So if you say that you're going to spend $3,000 in the year, but you have only contributed 1/12 of that because you only stayed with that employer for 1 month, but you spent all $3,000. Well, the employer is not able to get those funds back. They are expensed and they are not able to recoup those funds. If you're thinking about leaving an employer, make sure that all of those funds for the entire year are spent before you leave. The big thing is this is not a health savings account and it is not a health reimbursement account. Those I'll get to in different videos. All right, so what are the contribution limits for 2025? For the Health FSA, the contribution limit is $3,200 per employee. For a dependent care FSA, it's $5,000 per household or $2,500 if you're single or married filing separately. The carryover. So this is a big one. So at the end of the year, some plans, and it doesn't have to be all the plans, so be careful and make sure that you know the rules for your plan, but some plans allow you to carry over a balance for the entire next year. And for 2025, the limit for that carryover is $640. But that doesn't necessarily mean that they will offer all $640. Maybe they'll only offer $300, or maybe they won't offer a carryover at all. So make sure you know the rules for your individual plan. Another option that the federal government allows is a grace period, a 2.5 month grace period. So if your plan ends in December 31st, this will take you all the way to March 15th. And you can expense something in those 2.5 months. And then there's also a deadline of when it needs to be filed. So you could incur an expense on, let's say, March 14th, but you have until the deadline to actually file for that reimbursement. And those deadlines are different. A lot of times they're March 31st to April 30th or somewhere in between. So make sure that you know the rules for your plan. And how does it save you on taxes? Well, those contributions come off the top from your income. So let's say you make 100,000 and you are going to elect to do 3,000 into a flexible savings account. Well, now your income for the year will only be $97,000. So it won't be federally taxed, it won't count for Social Security tax, and it won't count for Medicare tax. So this is an important step. Here's an example, $3,000, you've got a 22% tax bracket, 6.2% for Social Security, and 1.5% for Medicare. So that takes you to 29.65%, gives you a tax savings of over $889 a year. That's $74 a month. So this is a significant savings if you take the time to do this. The other benefit is it lowers your adjusted gross income, which then helps you qualify for other items. These can be subsidies, FAFSA, your American Opportunity Tax Credit, or a number of different things, even the child care credit. So it lowers that AGI for all of those items. What is an eligible expense? Well, it's going to be your deductibles, your copays, prescription, dental, vision, over-the-counter medicines, even some equipment. But the one thing it doesn't cover is it doesn't cover your premiums. So if you have a wraparound premium or your own premium for your own healthcare plan, it doesn't cover that. So keep that in mind. For the dependent care, it counts for daycare, after school care, and summer camps. It even counts for if you have somebody in your home taking care of your children. So check out IRS publication 502 for a complete list of all of those things that count. The other thing is you can check out Amazon. They have its own FSA section where everything in there will qualify for FSA. And most likely you'll get a credit card that comes along with that FSA, and you can plug that number into your Amazon and it'll automatically deduct from that for all those FSA eligible items. So check out that Amazon. I'll put a link down below. Okay, so now for these health savings accounts, there is a big gotcha called the use it or lose it rule. This use it or lose it rule means that any unused funds at the end of the period go back to the employer. So this is a big gotcha and something that you need to watch for. So check what your employer rules are on the carryover as well as that grace period to make sure that you don't lose any of those items. So it does take some planning to make sure that you use all of those funds. So you want to try to underestimate those expenses, not overestimate, so you don't lose any money on the table. And especially if you have a carryover item where you can carry over $600, it's usually pretty easy to get in that ballpark and making sure that you're taking full advantage of those things for your normal recurring expenses. If you leave mid-year, you do lose all of your funds. However, the same thing goes on the opposite side, where if you leave early, your employer can't recoup it. So keep that in mind. That is a big one. These are the key takeaways for the healthcare flexible spending account. The FSAs will lower your taxes, but they do require careful planning and estimating at what your future costs will be for the next year. It also requires some follow through. You need to probably keep some receipts. You need to file those items with your FSA provider and making sure that you're staying on top, that all those expenses are getting logged through that flexible spending account. And please know your employer's rules when it comes to grace periods and carryovers. This is a great benefit for families, and especially for veterans that are transitioning to civilian jobs where we never had access to an FSA before. Make sure you're looking into this because this is a powerful tool that can save you almost $900 a year. All right, so the actions for you to take away from today are review your benefits in the open enrollment period. Know what your plan is and know what you're eligible for. Make sure that you go through all of last year's expenses and try to estimate what this year's expenses will be. Things like dental and vision are generally recurring, and you should be able to have a good idea of what those might be, as well as, hey, what is your deductible in your current health care plan? What is the minimum that you've spent every year prior that you can kind of count on for this year? So take that opportunity to estimate what next year's expenses are going to be, and then make sure you sign up. Make sure you sign up during that open enrollment period and get that on the books so that it'll start deducting from your January pay, and you'll immediately be eligible to spend all of the amount for the entire year in January, even though you haven't contributed to the funds yet. And then finally, make sure those funds are spent by the end of the year or the end of the plan year if you have a carryover. So I hope you found this video useful. If you do, please subscribe and please throw in the comments if you've got anything, or tell me what other videos you might like to see in the future. Thank you.
Information provided in this video is for educational and informational purposes only and does not constitute financial, investment, tax, or legal advice. I am not your financial advisor, and you should consult with a qualified professional before making any financial decisions. All investments involve risks, including the potential loss of principal. Past performance is not indicative of future results. This video does not endorse any specific investment or strategy. By watching this video, you agree that I am not responsible for any financial outcomes based on the information provided.